Good morning and welcome to our latest virtual roundtable brought to you by Bridging and Commercial and kindly sponsored by VAS Group. Thank you very much for joining us today. My name is Beth Fisher. I'm the Publishing Director at Medianett Publishing, and we produce the online titles Bridging and Commercial and Development Finance Today, and also the bi-monthly print Bridging and Commercial magazine. Today, we will be discussing what is likely to affect valuations this year and beyond. The valuation process is vital in every lending decision, particularly in the specialist finance market. However, when the figures don't come back as expected, fingers tend to get pointed and misunderstandings surface. Valuations are frequently cited as the cause of transactions collapsing, with bridging brokers and lenders often complaining of down valuations and how expensive and slow reporting can be. While the concerns are genuine and will ultimately impact borrowers, are they fair? In the last issue of the Bridging and Commercial magazine, we reported that there is currently an 8% gap between expected versus actual commercial property valuations. Consequently, it seems more could be done between valuers, brokers and lenders to set borrower expectations and protect clients' deals and valuers' reputations. We've also been witnessing the hardening state of PI for valuers, which has caused some 70% of valuer firms to reconsider whether they continue to work in the short-term lending sector. This is on top of an existing ageing valuer workforce. Specialist lenders are seeing the impact of these issues on a daily basis, all of which will inevitably create stress on turnaround times and the cost of valuations. After all, the service a customer receives is only as good as the slowest part of the process. Over the next hour, we will look at how brokers can take greater control, what steps they can take before the valuation process starts, and why a specific valuer is selected for their case and the reasoning behind certain costs and outcomes. The point of today's discussion isn't to generate blame, but to create awareness of how each party in a lending transaction can have more influence when it comes to the valuation process, and how they can best make the process more streamlined. So joining me today to discuss their own experiences and thoughts when it comes to the valuation process and what trends they've seen over the past year are a fantastic group of specialist finance experts. So I will now hand this over to them, who will each spend around 2 minutes of their own time introducing themselves. And I'd like to start with Stephen, please.
Good morning, everyone. My name is Stephen Todd, co-founder and chief commercial officer of the VAS Group, which consists of VAS panel, working with a large array of valuers around the country, helping place loan security valuations and working within VAS Audit, a valuation auditing and assurance company.
Many thanks for that, and apologies if my audio went a bit funny there. Dan?
Hi Beth, my name is Daniel Owen-Parr. I'm the MD of VAS Audit. Stephen's already told you a little bit about it, but we do a lot of auditing live and retrospectively of valuations, plus we do desktops, some PMS work and also sort of software as well.
Great, thank you for that. Colin?
Thanks, Beth. My name is Colin Anderson. I'm Executive Director of LDNFinance. We're a whole-of-market property finance boutique based in the City of London. We've been in operation for circa 5 years. Though myself and the co-founders have worked together for almost 20 years, providing property finance advice. LDNFinance has 4 core areas: high-value mortgages, residential mortgages, protection, and the specialist division. I head up the specialist division, which encompasses bridging, commercial, development finance. Looking forward to a very healthy and interesting debate.
Thanks for that, Colin. And Phil?
Thank you, Beth. Good morning, everyone. My name is Phil Gray. I'm the Managing Director of Watts Commercial Finance. We've been trading 16 years now, and we're a whole market commercial finance consultancy with offices in Cheshire, London, Cardiff, and Scotland. I too am really looking forward to today's debate. I think valuations will be very interesting over the coming 12-18 months, and hopefully there should be some really good content today.
Amazing. Adele?
Hi everyone, good morning. Thank you for inviting me today. My name is Adele Turton. I am the Managing Director of Plan A investment mortgage brokers and the newly named Blanc Property Finance. We specialise in more commercial investor type business. We deal with a lot of investors, a lot of developers. So the valuation reports we tend to see are more of an SIV basis than a comparable approach. So we tend to get much more in-depth reports. Genuinely looking forward to this debate today.
Thanks for that, Adele and Elise.
Good morning, everyone. Thank you for the opportunity to join this morning's roundtable. My name is Elise Taylor. I am one of the finance brokers here at Aureum Finance. We are a corporate finance brokerage that specialises in development. We support our clients with all form of property transaction, and we also specialise in equity funding for good quality developers in good locations. Really looking forward to this morning's debate and hearing all of your opinions in regards to valuations.
Amazing, thanks for that, Elise. So just a reminder to all the attendees today, you can submit your questions throughout the panel discussion through the chat box on the right of your screen. So please do so if you have any burning questions. We have actually had some ahead of today's event, so I'm sure we'll get some great ones going forward. But I would like to kick off with the trends that we have seen in the valuation market over the last 12 months, which I think is probably best place for Steve and Dan to discuss first. So Stephen, do you want to go first?
Yes, thanks, Beth. I think last year we saw overall it was a strong year, I think, for property values in most sectors. Like you said, Beth, we track estimated versus actual values year on year. They actually contracted last year, which means the market has got stronger. I think we saw quite a lot of volume in the buy-to-let market, residential development, refurbishment, and HMOs. Valuers, which obviously we're going to talk about more later, but I think they had to use the skills and judgment more than ever last year due to lack of comparable sales evidence. Insurers in the PI market have definitely been sort of driven more restrictions on valuers in terms of what they can and can't do. There's a lot of valuers that aren't allowed to do peer-to-peer valuation work, which and I think bridging is definitely changed. With VAS, we've worked really hard with insurance brokers and insurers to sort of tell them what's going on with the bridging market and how sophisticated it is now and the complexities and specialisms within it. So I think those were the common things we saw last year. I think this year will be we've had a great start to the year as well, so we're hoping it's going to be more of the same again.
And what would you add to that?
I think Stephen's covered off majority of the sort of main issues there that we saw last year. I think in sort of from my point of view, the main thing is I'd say the issues we had with PI, which sort of were very prominent sort of 2019, 20, sort of stabilised 21, and I think that was the good thing to see, that we're not seeing large increases in PI for valuers coming through. Yeah, restrictions are coming in, but it's nice to see that we're not seeing firms disappearing at the same scale as they were last year.
In your opinion, which locations, sectors and asset types do you expect to see valuation growth in 2022?
I think one of the main areas is going to be around anything that's green, sustainable, that type of property that's going to be big. If you look at a lot of buy-to-let lenders are coming out around sort of EPCs and sort of only lending or moving towards only lending on things that have got sort of a C or above rating on it. So I think that's going to be really, really big. I think sort of areas, I think anywhere that's sort of a regional town sort of hub, sort of outside London, that's got great communication, it's got really good transport links, maybe close to an airport. I think that's going to be, where we're going to see the real growth in that. I think, from what we're seeing, that the initial sort of escape from London has changed a little bit now. It's not all as green when you disappear out into the countryside. It's not always as easy to get back in there now that people are moving back into the offices, even if it's just for a hybrid or role. So I think that's the two major ones that I've seen myself there.
Steve, would you add anything to that in terms of kind of trends and geographies which you're seeing growth or expecting growth?
I think we'll continue to see a lot of residential development. I think there's still obviously an imbalance of lack of demand versus supply of new homes. I think that there's an opportunity on permitted development. We saw that with offices a few years ago. A lot of offices in secondary towns being converted to residential now. I think you're going to see that with retail. I think sort of smaller towns and villages are going to see that the peripheries of the retail areas get converted, so the actual retail areas will contract. But I think there's definitely opportunities there. HMOs, again, if it's done properly, and the buy-to-let market, I think we're going to see we're going to see more now international investment coming back into the UK, and they're going to be targeting residential opportunities and private rented schemes. So I think we'll see a lot of that this year.
We've got a question from the audience that's about buy-to-let. I think it's probably a good time to ask that because you just mentioned it. And they've said, apart from comparables, what is the alternative approach for buy-to-let properties? I assume they mean valuing.
It's generally done on a comparable approach. I mean, as you go into HMOs that are more specialised with licensing, that's when the investment approach does arrive. And valuers always look for a secondary method, so they'll generally value residential on a comparison basis. So it's either rate per square foot or 200,000 versus 210,000, making deductions for condition, location, etc. But residential is generally valued on standard. Buy-to-let is generally on the comparison method.
Okay. Where do you expect to see valuation challenges this year? Adele, shall we start with you on that?
Yeah, I think there's obviously going to be some correction in the market. I think we've all been bracing ourselves for the last 2 years. And it hasn't come, we've just continued and continued, and you have to wonder if we're at the peak now with inflation rising as it is. I think on the wider picture, if you look at growth within certain cities, it's definitely there. I think we have also got, and I won't say an issue, but we've got things have been driven by CBILS and bounce back loans have hyped up demand in asset classes. You've then got to feed in all the other things that add into that, rising shipping costs, all these other aspects. You've got VAT, shipping costs, rising materials, staffing costs, lack of staff. I mean, everybody knows that you're trying to and recruit at the minute. It's very difficult, and even more so within the trades. We deal with a lot of developers and trying to, or landlords that are refurbing the HMO model that Stephen referred to. And the issue of getting builders on site on time is difficult, and I think within a valuation you have to allow for these things that are increased in costs or time. I think that's one of the big areas that I've seen in the last 2 years. There's so much activity, but it's tilted. It's great, but there is other factors that I have to take into account, and it's generally down to those things.
So what challenges have you seen or expect to see in terms of valuations this year?
An interesting, I mean, some great points made already. One of the interesting ones we've been looking at is with the increased costs for developers in terms of materials. We've seen steel prices rise, increased school and council levies, Section 106s. I think that's going to be interesting to see. Does that drive down the value of land or drive up the house prices? Because we have got a shortage of houses still, but with the rapidly rising cost of materials, how is a developer supposed to make a margin on a development? And it'll be interesting to see if property prices, if there is a correction in the market, which Adele's just alluded to with regards to, you know, as the market corrects itself this year, then are we going to see an impact in land values? Because, you know, otherwise, how is a builder supposed to build houses if there's no margin? So I think the development side of things will be very, very interesting this year. Obviously, we've also got political instability, the potential of a new prime minister, rising energy costs, interest rates, and just the overall economy. So I think all of those things will play a part over the next 12-18 months in terms of how we see the property market, and then that then will filter down into the valuations that we see.
Absolutely. And we're obviously seeing rising costs across the board, and like you said, in terms of living costs and development costs, because of material prices rising and labour shortages, etc. We have a question from the audience asking about whether or not valuer fees will change this year. So that might be one for Dan and Steve to answer. Do we expect them to continue rising, or what do you think?
I think that I'll go on, Dan, sorry.
I know you carry on.
Yeah. I think there's an issue in terms of the demographic of valuers. The average age is in the early 60s. There's a lack of new people coming through. 2008 recession and a lack of sort of graduate opportunities. There's a generational gap, and we're seeing that right now. And there's been delays because of Brexit and COVID in terms of them coming through, and it's hard to entice people into the sector. I think with like Dan said, I think the PI market is settled, but they're still paying 2 to 3 times more than they were 3 years ago. So I think that it's to answer the question, the fees are not going to go down, because literally valuers are cherry picking the work that they're doing. We're doing like 1,000 valuations a month at the minute, and we've got some fantastic relationships with valuers, but they are incredibly busy with other lenders across the market, high street lenders. So I do not think that fees are going to go down. Unfortunately, we're in a world where they get quotes, 3 quotes, invariably they're going to go for the cheapest. So they'll still get the cheapest option, I should imagine, of the 3, but they're not going to go down.
Is this as a result of more, because obviously you're saying we have an aging workforce and we don't have enough new blood coming into the valuer market, but is this a consequence of more lenders entering the market, because that hasn't stopped in recent years?
I don't think so. I think that the valuers, this works. I think the opportunities have been driven more into the bridge and challengers sector than potentially the high street. So that work would have been there anyway. I think we're just seeing a higher proportion of it because of the high street lenders potentially not doing that work. So I don't think that's the case.
Before we go on to some questions about changes for this year, I want to ask an audience question about kind of trends. The question is, I know it's difficult to accurately predict, but do the panel feel that residential and commercial property values will peak and retract in 2022 and into 2023? Does anyone want to pick that one up?
I'll go. I think residential will stabilise. I think we've seen a huge spike in the last 2 years. I think it'll stabilise. I think more will come on the market, and more people will feel more comfortable to actually move because of COVID and feel comfortable to go and view other people's properties. I think the commercial sector, I think there's all sorts of opportunities there. Industrials, the most outperforming sector for many years now, and that will continue. Offices, I think you're going to see smaller offices being more favourable and being able to move around. We've got obviously 2 offices. We're looking at an office in Edinburgh, South Wales, to have that ability to have a base. But I think the question around leisure and those kind of sectors, hospitality sectors, we're unsure about that at the minute. So we've not seen many transact. So I think that's the only question mark I'd have in terms of where the values will go.
Okay, great. Thanks for that. My next question is all about the changes that brokers, lenders and borrowers need to be aware of this year and into next when it comes to the entire valuation process. We've got things like Red Book changes. We've mentioned it before with the EPC, sustainability efforts, and then just kind of just general trends in valuations and working methods, price, PI, all that sort of thing. So what changes should everyone be aware of this year? And shall we start with Colin? Do you want to start with that one?
Yes, thanks, Beth. I expect we'll see more lenders look into, I'm not just saying this because I'm here on the panel, but I think we'll see more lenders look into adopt panel management groups, i.e. like VAS. We've seen quite a few lenders trying to move away from instructing their own valuations. So, and the advantage for that in my mind is by using a panel management firm, it allows you to get the right valuer, someone who is able to, I guess, be familiar and aware of the right asset type. So I think that's one thing to be aware of. I also think we'll see more automated valuations as well, AVMs, desktops. Already quite a number of residential and commercial lenders use them for low LTVs. So I think those are probably two of the key things we'll see.
Great, thanks for that. Elise, what changes do you expect to see this year in terms of valuations, and what should borrowers, what are you kind of getting your clients to be aware of?
I think from my point of view, as we all know, there are many cost increases across the board, but just ensuring that developers, contractors have taken that into consideration, that their tender docs are in date based on recent purchases and costings. I think that's very important. And I'm also trying to work in a little bit of extra time when handling an application, just because I think it was, as Stephen said, valuer availability is running a little bit low. So I'm advising my clients to include an additional 1 to 2 weeks at least to get that valuer out and get the report back. And I think that managing that timescale helps everybody understand that the report may take 10 days and we are all on the case and doing our best. But if you add that 10 days to your process, you're not then delayed. So I would definitely say cost increases, contingency, and being realistic with timescale and valuers availability is really key.
Stephen, what would you add in terms of other changes to expect this year? I know that you've mentioned to me a few times about RICS changes and EPC changes. What should brokers and lenders be aware of?
Yeah, I mean, the RSS have come out with a paper about how valuers should be approaching the EPC side of things. I think it's not really been reflected in value before. I think it's just about, it's a requirement that you need. I think valuers will have to look more at that, especially as we get to that 2025 landmark date, in terms of having to be sort of C or below. I think that yeah, I think we've mentioned quite a lot of it in terms of PI and then the fees. I think valuation in the residential world has seen lots of technology changes and efficiencies, where in the commercial world it hasn't. There's still a lot of manual processes. I think some valuers will try and get more shortened report templates, which I think I'd encourage for vanilla properties as long as they're Red Book compliant. But to try and keep up with the times, I mean, the bridge market, timing is seriously important. So I think any way we can look at efficiencies, and we're looking at partnerships with all sorts of technology firms to try and introduce our values to them, because they might not necessarily be aware of them, to try and help them speed up what they do, but not affect the quality. But ultimately, I think as is the case for decades with valuations, I think getting the experienced valuers in the right areas who know that sector and getting that figure right is the most important thing, lending off the correct valuation. So I think we'll just see more of the same.
Thanks for that. I've got a question from the audience just based on fees, just following on from the fees question that was asked earlier. The fees that borrowers pay also include panel manager costs. How much as a proportion of the total valuation cost is fair for a borrower to pay a valuer intermediary? Should the panel manager ever receive more than the valuer for an instruction?
So yeah, no is the answer. It's a small proportion of the overall fee. I think borrowers sometimes won't realise what goes on in terms of a panel manager, in terms of the technology we provide to our customers. And the team that's involved in getting these things right. We've got a dedicated quotes team in order to make sure we're instructing the right valuers. We've got a team collecting fees on behalf of the broker or the lender. We've got a team dedicated to supporting valuers, getting documents, getting leases. We've got a team that supports quality control. So we're making sure these reports are right, they're in line with the lender's instruction letters, they're correct essentially. And we've got a management team which helps with post-valuation queries. We've got SLAs, valuers have to respond to our post-valuation queries in 24 hours. Everything's set on set SLAs. Everyone knows how we work. So we provide that function of making sure this thing's done correctly in line with the lender's instructions, back on time. We're getting 80% of our reports on time, 90% within an extra day. So I think the relatively small margin compared to the overall valuation fee to keep this sort of the industry on track and doing it properly is like I say, some lenders choose to go directly, but then it does definitely mess with efficiencies. I think valuation is only one part of the whole process. So if we can make sure that that part's done properly, then the time to cash is kept on target or reduced, which helps the industry.
What would you all say are the biggest misconceptions of the valuation market, and how are those misconceptions hindering deals? Phil, do you want to start with that one?
I guess, well, probably the biggest misconception in the marketplace, I don't think customers and people out there understand the huge percentage of PI insurance that goes when they look at what a valuer charges. But I don't think that really hinders the marketplace. I think I'd echo what Stephen started with. I mean, our turnover was 20% up last year, and we didn't see a problem with valuations. We did immediately post-COVID, where the world froze. But once we sort of came out of that period, you know, it's interesting now. I don't do deals anymore, but as running the company, I only sort of hear noise when there's bad news, and I hear very little noise nowadays around valuations. Yes, they're a little bit slower. Yes, we do. You know, hopefully now that we're coming out of COVID, we'll see more consistency from valuers. Hopefully, as things calm down, we'll see valuers getting back to more realistic figures as opposed to protecting the PI. But all in all, I think probably the biggest misconception, my brother-in-law, sadly before he passed away, was a surveyor, and you know, when he actually used to break down the cost of a valuation with PI and travel, etc., I think sometimes customers don't understand that there is a huge, they think it's just literally the price of a person going out, filling in one-page form and sending it back, and sometimes that can look very expensive, but actually when you factor in the PI costs and all of the other associated costs, I think that's probably one of the biggest misconceptions in the market from a customer's point of view.
Whose responsibility is to manage that expectation?
The brokers, the lenders, and but predominantly we're here today on a broker channel. So you know, ultimately it's the brokers to help the clients understand the cost of a valuation and what goes in to making up that cost. That said, we don't get a huge amount of fight back from customers. Again, you know, I think valuations, I think it will be interesting to see, I think the two things with today's presentation, that it will be interesting to see what happens with values over the next 12, 18 months. But the actual valuation process itself works really, really well. And we've worked with Stephen and the guys for years now, and it works extremely well. And as I say, that's borne out by the fact that I have very little noise from my commercial team in terms of problems with valuations. So I think there's two things today. I think what's going to happen with values over the next 18 months is very, very interesting. I actually think, you know, let's not mend something which isn't broken. We have a fantastic valuation process in the UK. Yes, it can always be improved. I mean, it's interesting, since we've opened up in Scotland, my Scotland managers, you know, when I asked them for some feedback on today, they basically came back with, you know, we've got a lack of panel. It can lead to up to 5 weeks to get a valuation back. So there's interesting things where we can always improve, but you know, we have fundamentally got a valuation process in the UK that works very well.
I would completely agree, and I think people in the audience are also agreeing with you. I had just one comment just came in as you were speaking, saying the valuation process needs to be explained or sold as an investment and not as an expense, which I would wholeheartedly agree with. Elise, what would you add in terms of misconceptions you kind of frequently hear or see?
I would say I'm really seeing a lot of overinflated land values from owners, existing owners, thinking that they're worth considerably more than they actually are. I've had a couple of instances where we've been out with terms and situations, clients have had offers accepted, we're looking to purchase, and then all of a sudden the landowner's decided it's worth an extra $500,000 and they're not going to transact unless they get that. Obviously that's going to eat into a margin, and I think that's something we've been seeing a lot of. running through the calculations and how we work out that land value with the owners to try and educate them along with the buyer so they can work together. But overinflated land or property values is something I'm seeing quite a lot of from the sellers, I have to say.
Adele, are you seeing the same thing from landowners?
Yeah, absolutely. I think when we talk about residual value and then it coming out of the margin, 100% allocate deals, and the land is nowhere worth what they're trying to sell it for if you work it back. I think to add to what both Phil and Elise have said, another misconception is, it's going to be a bit controversial, is that a down valuation is a bad thing. It's not necessarily always a bad thing. The surveyor is there independently working for the bank. They're actually also got your interests at heart. You've got to appreciate that surveyors have seen things come and go over the last however many years they've been in business. And they will have been through, most of them, through that horrendous time that none of us talk about anymore. And it was the surveyors that got hit severely. I mean, obviously we all did, but the surveyors were sort of hung out to dry with that. There is a little bit of that who wouldn't be scarred by that experience, but I think also they've sort of got you back. You know, if something is coming, is it coming in 12, 24, 36 months, and you have over leveraged, let's just talk about a buy-to-let or a HMO now, and you're trying to refinance in 2 years, but you have over leveraged now, you're going to get stuck. So sometimes you maybe need to see it as a bit of a warning, take heed, as long as it's not too severe, of course. That's kind of that's the advice we sort of say to people. You need to maybe look at this. This is not, they're not the bad guys.
I think the word down valuations is used a lot, and I hear it a lot when we're reporting. Is there such thing as a down valuation? Dan, Steve?
Personally, I'm not sure that it is. I take Adele's point there, and I think she's got a very pragmatic point about it. I think it is out there at the moment in time. There's a lot of prices, both for buying and selling property, but also rents. You know, because of the lack of stock on the market, the prices seem to have gone through the roof. And landowners, like Elise was talking about, increasing their price because everybody's trying to recoup maybe some money that they've lost throughout the sort of lockdown periods of COVID. I think if you have a proper engaged conversation with the valuer and the evidence is in the reports to explain why they've come up with that figure, then yeah, I can see people get disappointed. And I know higher leverage deals for the broker and the lender, you know, are specifically looking for a figure, and it's very disappointing if you don't quite reach that figure. But you know, I'll come back to what Adele said there, is that the fact is that we're at a position now where it could go either way with inflation and everything like that, and prices could, you know, possibly come down, and they are trying to protect the lender and ultimately don't want the clients to be buying something that's overpriced. So I'm not 100% sure it's down value, and I've never come across a valuer that has deliberately reduced a price. I think it's all about the quality of that report and the quality of the evidence. So if it's buy to let, the comparables, are they the best, you know, comparables, the closest to probably the most relevant sold, as well as, you know, on the market there, then there. And I think it's that conversation between the valuer, the broker, and the lender, you know, to represent their client.
I think also as well, you know, this is a fantastic benefit of working with VAS or the panel management companies, as Colin alluded to, because, you know, there are some valuers out there who over recent years, due to COVID or the PI insurance following on from Grenfell or whatever, who have been, shall we say, a little bit cautious. And that's where the VAS will bring real value to the table in terms of not necessarily always making sure that a valuation value's up, but by, you know, not necessarily using the valuers who have developed a track record of down value and things. I do think they're at that. There is no industry is perfect. You know, no lender's perfect, no valuer's perfect, no commercial brokerage is perfect. And one of the benefits of using something like VAS is that hopefully you'll get a more consistent approach from the valuers, you know, which is beneficial to everybody.
I just wanted to add also that there is a misconception that evaluation is completely subjective to the valuer, and it depends on what side of the bed they got out of that morning as to whether they're going to be in a good mood to give the valuation required or not. So and I think that's something we also need to work and challenge against. But it's also important to understand what the valuation remit is for that lender, because every lender works towards different valuation covenants, and it's not one valuation fits all. And this I had a case last year where a client had come to me after going with an alternative broker, and he was looking to release equity out of semi-commercial assets, commercial on the ground floor, resis on the upper. Valuation came back not to the value he was looking for. He would say, oh, crooks, can't believe they've done this to me, etc., etc. I said, send me a copy of the valuation, let me have a look at it. Straight away, I saw it was based on a 90-day valuation. Now, the broker hadn't made the client aware of the difference between your open market valuation, 180, 90-day. So he said, well, I don't understand why this figure has come out as it is. And I've then had to explain to him what the process was. Now, unfortunately, that was a very expensive exercise for him, because he'd spent £2,000 or £3,000 on the valuation, and that lender was never suitable for that client. Now, that's not the lender's fault. They had their valuation covenants. The valuer were working towards those covenants. That should have been explained to the client how it worked. So I think it's important as brokers, we fully understand. If we're going to recommend a lender, we need to understand their covenants, what they work towards. We need to fully understand the type of valuations available for a particular client.
That's a really important point you just made there, and I think fully explain, especially when there's big costs involved, as you say, fully explaining those loan covenants and what lenders have in terms of valuations. What are you all seeing in terms of like most popular or what covenants from lenders? What is the kind of valuations that they're looking for in terms of 90-day or open market, whatever it is?
I think most go with open market. I think you sometimes, so go back to HMO analogy again, if you're looking at an inexperienced landlord on a commercial based asset, and when I say commercial, I mean like an investment based valuation, you're going to see a lot of them will cap it at 180-day, because whilst they're happy to use the yield-based valuation, they also want to pull it back a little bit so that they're not leveraging. So if you can get 75% against the 180-day, it's like a happy medium. It's almost like a blend. Whereas if you go to a lender that when you've got experience, you'll get full 75% against open market. And I think explaining that to clients is really important. Also, you have lenders that change these criteria that Colin was talking about. This does change, and throughout COVID, we all know it was like that. There was people dipping in and out. It was a bit of a dance. So there are some there's very few on a term basis that go in 90-day. I think that's probably more of a bridging market. Certainly more towards what would be deemed as a riskier asset. Throughout COVID, for example, retail, they're going to look at a fire sale figure because in case they take possession, they need to get rid of it quicker.
I have a statement, I would say question, but a statement from one of the audience members saying, I think brokers need to make it clear to clients that an estate agent's valuation is very different to a mortgage valuation. And I think that's where a lot of disappointment comes from. I think we were talking about that earlier, about the kind of expectations, managing that. Would you all agree as brokers?
Very much. I feel that sometimes a client can be an agent and have an impression of that this property is going to be worth, again, I'll use £1 million, but then ultimately a valuer is going to come in, use the comparables, look at the sales that were achieved, and that might come in at 750. And that can sometimes create a situation where the client's expectations are not met, but ultimately it's been overinflated by another. So
there's a hierarchy of evidence, Beth, where sold valuations is number 1, under offer is number 2, on the market's number 3, and I guess estate agent's advice is number 4. So it's the lowest point of any evidence. So valuers are always going to go to the very top, which is actual sold evidence.
What, going back to our questions about influence, what more can brokers do to influence a transaction and manage expectations?
I think being realistic is key from my point of view. You have to be realistic. You have to be honest with your client based on current market trends and perhaps things you've seen very recently. I think that that's really important. Realistic management of expectations and real conversations based on factual content.
I think from our sort of point of view, it's that sort of data and information. I think as brokers, one thing I could always ask brokers to do is try to get everything day one. You know, and I understand deals are hard and it's a competitive world, but the valuers get drip-fed information, and that makes it difficult. And real open and honesty, so transparency. You know, we've seen situations where we're told one situation, the valuer is booked to go out and appears out. You know, it's meant to be a finished building and turn up and it's still a demolition site basically. You know, they can't get access to areas. There's no electricity for the basement. There's varying things like that. So I think, you know, one thing, you know, valuers will always ask for is that open transparency, because it makes it easier to get a quote, to get it back in time, because you don't want to find out a pertinent piece of information 2 weeks down the line. So if I could employ you to do one thing as brokers, is get everything day one, and then you're going to get a more accurate valuation, less likely to get downvalued, more likely to be completed on time, and hopefully then get the outcome that you guys are looking for.
I think we also do a lot of due diligence, test the mettle of the information that's being given by the client, do some market research, look at the location, look at market rents, look at all the things that they're saying is arrived at their GDV. The number of investors that I speak to who are relatively new don't know what a yield is, yet they're asking for an investment-based valuation. Like, right, we need to start back at the beginning. And it's about education and preparing, and also preparing for a plan B and a possible plan C. You know, if these are your three figures where it's going to come in at, do these options still work from a broker and a client outcome perspective? But I think also if you've done that and the valuer meets the client and they're reasonable and open to these different figures, let's say, and different scenarios and rationales as to why you've got there, it just comes across much better. And also the client is more prepared for, let's say, a little nibble on that figure. It's just I sometimes find myself I'm a bit of a grim reaper of estimated value. I'm like, no, let's start again. But I just think you have to manage those expectations, because it's not a nice conversation. It's come back lower.
The audience, I think, completely agree. I've had one comment saying that one concern as a valuer, so this is a valuer speaking, is the poor quality of information provided in advance of us attending the property. If this is improved, the gap between expected and achieved values would be narrower. So I think that just kind of confirms what everyone is saying today as well. So that's really important. Is there anything else that brokers can do to influence the property transaction, apart from giving more information up front? Anything else that can help streamline it?
I think Colin made a great point before about basis evaluation. I think that's fundamental, because knowing what a lender's going to lend off is critical. I was given an example of a shop that's let for £10,000 might be worth 100,000. On a 180 it might be worth 90, on a 90 it might be worth 80,000, and vacant possession it could be worth 90, 80, 70. So you got a 30% swing from VP 90 to market value, and it's the same valuation done on the day about as a point in time. And I think one thing we've seen recently on some bigger transactions is potentially speak to the valuer. We're always happy to put brokers, lenders in touch with valuers directly to have a chat about something in advance. We had a case recently with a shopping centre where I think the valuation fee could have been £25,000, but we decided to get a desktop up front, and desktops very rarely change from once the valuation is done and the property's been inspected, unless something physically or condition wise is wrong with the property. So I think getting the right basis and getting surety about that figure day one, then you'll have a lot less friction and the client's going to be, there's not going to be any hurdles, less hurdles in the way to essentially brokers don't want to upset the clients, and I think getting that right at the start, then that shouldn't happen down the line.
I think it's a really good point, and I'm still thinking of the comment that Colin mentioned earlier about, you know, the broker that didn't give the information up front with the borrower about what the valuation the valuation requirements would need to be. Is this a result of more kind of inexperienced brokers entering the specialist finance market? I'm quite interested because I know that all the brokers on this panel, you know how to manage expectations, you know what information to give to the valuers and lenders and borrowers up front and what needs to be included. So why are we seeing these issues?
I don't think it's necessarily new entrants to the market. I think it's just, you know, quality of the individual broker or the firm that the client's working with. You know, there are some very, very good new entrants into the market who would do the job very, very well. So I think it's probably unfair to say just new entrants. I think it's, you know, as an industry, we can probably do a better job across the board. Of, you know, Stephen has just made a very good point there about, you know, there's no point proceeding with a client if you need 70% of the open market if you know that lender's going to use a 180 day. So I think it's upon all of us, the more senior brokerages in the UK, the lenders, you know, B&C, everybody in terms of that educational piece to all brokers out there, irrelevant of their length of tenure, to make sure they get that bit right. I think sometimes it's probably, you know, a little bit of overexcitement. The deal's about to proceed, the deal's going to move forward, so therefore let's get it to valuation, let's get it moving, and these things are missed. So I think it's just a general area where, as an industry, we can be better working with our clients and educating them. And Adele and everyone's made some great points about, you know, sitting with the client and actually making sure that before you press the button on a valuation, that we're all singing from the same hymn sheet and that the valuations are realistic, understand where the client's got the figures from, and actually spend a little bit of time with the client, because there's nothing worse than spending the client's money on a valuation only for it to be fruitless.
I think as well, it also comes down to education. I know when Adele referred to that, it was more for clients, but I think in-house within a brokerage, with your admin team, with new starters, I think education is really key. Understanding those lenders, making the time to meet with those lenders and understand their processes, what they're hanging their hat on, and then roll that out with the team can help you then give better education to your client. I think from my point of view, since I entered the sector, I've always said that knowledge is key. And when it comes to valuations and what lenders are going to base their terms on, I think that is paramount. So I agree with Adele, but roll that education out to the rest of the team as well as your clients, most definitely.
And I think just finally, it's important on an educational point that, you know, that we play our part for clients to do the right due diligence, because we do have some very experienced developers and investors coming to see us that haven't done that due diligence, which is surprising. So I think whilst it is the broker's responsibility as the client's professional advisor, there also has to be some responsibility with the individuals that, you know, to actually go away and do that due diligence before they present an application for finance, to have done the correct due diligence and to be aware of what's happening in the market. I don't think it's about abdication of responsibility. It's about sharing the responsibility.
100%. Before we just go on to some final audience questions, because we've had a lot, are there any kind of final comments that any of you have in terms of what all parties, because as you say, responsibility is shared, what all parties can do to make the whole valuation journey easier? Any final statements before we go on to audience questions?
I just think it's definitely honesty, be transparent, be clear, present with warts and all, and then everybody knows exactly where they stand.
Just to add to that, just that communication piece between all parties, and try not to sort of, talk about a transparency piece, just try and communicate completely all the time. And I think it will be a much smoother process.
Okay, brilliant. Let's go straight onto the audience questions as we have 10 minutes left. First one here, why are there sometimes disparities between two different valuers on one property?
I'll take this one, Beth. I think ultimately it's an art, not a science, which is a famous expression, valuations, and people will have different opinions. the RICS has 5 methods of valuation, which generally people with the right experience will follow the right methods for the right properties. And again, it's people's judgment that they're making based on comparable evidence. I think at VAS we'll always, if we ever get a case where someone's had something valued, we'll always take a look at it. We've got 3 chartered surveyors in-house, so we're not just a post box, so we can review something and we can see where someone's come from and rationalise why people have had different approaches. But I think that's the key, understanding why they've approached something differently to somebody else.
Great, thank you for that. Next question, do you expect there to be an increase in valuers unable to attain PI renewals this year in the bridging market? We have seen a few valuers drop off due to this last year.
It's definitely settled. We've seen some. I could count on both hands out of the 190 on our panel of people we've lost, but what I think they'll do is place further restrictions rather than on what they can do. So in terms of the lenders they can work with, the RICS is encouraging limiting their liability. So instead of getting a 2 million, 5 million, 10 million pound policy, you might get that subject to a 70% of market value, whichever is the lower, which generally the percentage of market value is. And more firms, the biggest firms in the country do that already, and I think the smaller firms will start to do that.
I think one quick point on that, I was looking at the figures last night about renewals for our valuers, and of the 16 that renewed in January, none of them reduced their PI. So yeah, some of them will change that. Some of them, 2 of them went up in the amount of PI that they've got. So that sort of losing PI or downgrading amount of PI seems to be stemming now.
Okay, that's good to hear. There's another question here about lease terms. How do valuers look at different lease terms that might impact demand? Different lease terms may mean that comparables are not true. How are leasehold details accessed?
It's generally from ringing around. Well, there's comparable data sites like Radius and CoStar that's got letting information on, so you know the length of the leases. Generally, valuers value to either expiry or break clause. So the 25-year lease is gone. They're generally 10 years with a 5-year break, or generally 5 years with a 3-year break. So valuers will assume that the customer will break and then factor void periods into the valuation in order to allow it to be relet.
Okay, another question. What is the view on different valuations for sale and remortgage? The loan to value margin is very narrow when we get the instructions for valuations. Don't know if any of you have something to say on that.
I think that's always been an interesting one that we challenge with the lenders. I think that's perhaps less about the valuers and more about the lenders' appetite for the 2 particular sectors. And it's more about the lender double checking what sort of, for want of a better phrase, what skin in the game the client still got in that property. So I think that's probably more of a question about lender appetite as opposed to valuers. So probably whether it's a good point, and it's a great question. It's one we sort of discuss heatedly with a number of lenders as to, but it ultimately comes down to, equity, skin in the game, how much actual physical cash or hurt money the client still has in that property. Obviously, it's more clear cut on a purchase than it is on a remortgage.
This question is, on average, what do you feel is the average time from val instruction to receiving the reports? The whole industry seems so busy and not enough surveyors to do the volume. Stephen and Dan, you've probably got some answers there in terms of your reporting and your data that you've got.
We work off on the residential template, the short form for vanilla properties, work off 2 days from inspection, and we work off 6 to 7 days on the long form reports. The development appraisals generally take around 10 days. You don't really see many people. So then big national firms always take longer generally to get these things back. But the more complex, the longer. But on average, that's from inspection, not actually instruction. Normally it takes a valuers, I don't know, you might have 2-3 more days for them to get a space in the diary for them to get out and visit the properties.
I think, Stephen, the final point, I've sort of registered there that it's about that gap. We have a lot of, we sort of put a window of 24 hours from when somebody wants to book a valuation and then pay for it. And a lot of the time that sort of elongates. And that's where brokers can really help in the fact of, if they want to go ahead with this, it's getting that fee paid, because once that window is gone, you're sort of then going back in with all the other instructions that the valuation firms have received. So that's when that elongates the transaction, and getting the valuation back is that time from paying it, agreeing it, paying it, and then going through.
And we have another question about the tech, which I think was brought up earlier in the discussion. Can you expand on types of technology you are seeing that can speed up the end-to-end valuation process? Is there anything that any of you are using or have seen which has been helpful?
I think on the residential side, do you mean for the valuers to help them, or for the brokers to get information to pre-qualify, Beth?
I believe it's both ways. Here it's the whole process. Yeah,
I think for brokers, there's CoStar for commercial properties, which is it's relatively expensive. Radius less so. You've got property data on the residential side, which is really interesting. They seem to be investing all seeing new features all the time there, where you're getting the right rates per square foot. It gives you title boundaries. Adele's have got a comparable system and title map boundaries. Rightmove Plus, obviously, which everyone's aware of. So there's definitely things out there. In terms of systems for to help valuers, there's Quest, which is generally the mass residential mortgage market is on Quest, which is quite an old archaic system. They've got forgotten the name of it, owned by Landmark. I'm sure Dan will help me. There's another system out there, Etech.
Etech,
yeah, being used for valuers. There's valuation software like Kel, which is great for investment and residual appraisals. Kel is great because you can, the RICS encourages sensitivity analysis and residual appraisals, so that's really useful to have to see if if build costs go up 10% and sale values come down 10%, what happens to these values? It's fantastic for lenders then to see the risk profiling. So there are things, but in the commercial space, no one has brought all these things together on an API to allow as a one-stop shop. So the due diligence is still a very manual, long-winded process for the valuers.
Thanks for that, Steve. We are 2 minutes to 12, so even though we do have some final questions, what I'll do is I will send them round to our panel after today's discussion, and I will hopefully get some of those answered for our audience members today in our write-up next week. So if you do have any questions, or if you've got any which you think of after the discussion which you didn't manage to ask, please feel free to email me at beth@medianett.co.uk, and I can pass them on to the panelists today, who I'm sure would love to help. So I would like to thank Valuations for partnering with us on this today. I thank you to our fantastic expert panel for taking time out of your busy schedules to be here, and I also want to thank you, our audience, for joining us. We will be publishing this roundtable in full next week on B&C for those that weren't able to make today's event. If you enjoyed this one, please do check out our virtual roundtable calendar for this year on B&C and DFT. We are holding events throughout the year on a variety of subjects. And also, if you'd like to receive a copy of the print B&C magazine, please remember to subscribe on our website. I've also given a link in the chat box. Apart from that, I hope you all have a fantastic afternoon, and we hope to see more of you in person soon. Thank you so much.